Have you ever wondered what would happen if you invested just $1,000 into a powerhouse ETF 5 years ago? Today, we're peeling back the layers on QQQM, the Nasdaq 100 ETF, to reveal exactly that. Let's begin by understanding what QQQM actually is. QQQM, or the Invesco Nasdaq 100 ETF, is an exchange-traded fund designed to track the performance of the Nasdaq 100 index. This index comprises 100 of the largest non-financial companies listed on the Nasdaq stock market. Think technology giants, innovative healthcare firms, and leading consumer discretionary businesses. Unlike its older, larger sibling QQQ, QQQM is structured for long-term buy-and-hold investors, offering a slightly lower expense ratio. It's a convenient way to gain diversified exposure to some of the world's most dynamic and growth-oriented companies. We're talking about companies driving global innovation and digital transformation. Its composition means a significant weighting towards the tech sector, making it a popular choice for those betting on continued technological advancement. Now, let's set up our exciting hypothetical scenario. Imagine precisely 5 years ago, you decided to take $1,000 of your hard-earned money and invest it directly into QQQM. Now, a quick clarification. QQQM itself launched in October 2020. However, its objective is to track the Nasdaq 100 index, just like the much older and larger QQQ. For the purpose of this 5-year analysis, we will use the performance of QQQ, assuming QQQM would have mirrored its returns had it existed. This provides a robust and accurate representation of the Nasdaq 100's performance over that specific historical period. So, November 1st, 2018 was the starting point. You had that $1,000, you made the decision. No special strategies, just a lump sum investment. You bought into the future, into the collective strength of these top 100 companies. What did that decision mean for your capital? How did the markets treat your foresight? Let's delve into the numbers and see the impact. Fast forward 5 years to today, November 1st, 2023. During this period, the world experienced significant economic shifts, a global pandemic, unprecedented monetary policy responses, supply chain disruptions, and a surge in technological adoption. The Nasdaq 100, heavily weighted towards tech, navigated these tumultuous waters with remarkable resilience and growth. On November 1st, 2018, the approximate price of a single share of QQQ, which QQQM mirrors, was around $160. Your $1,000 investment would have purchased approximately 6.25 shares, 1,000 divided by 160. Now, let's look at the value on November 1st, 2023. The price per share had soared to roughly $380, so those 6.25 shares would now be worth 6.25 multiplied by $380, which equals $2,375. That represents a significant capital appreciation. From your initial $1,000, you would have seen a return of $1,375, an impressive 137.5% gain over 5 years. This period showcased the substantial growth potential inherent in innovative, market-leading companies, even amidst global uncertainties. It underscores the power of long-term investing in high-quality, growth-oriented assets. Think about it. More than doubling your money without any active management beyond the initial purchase. The compounding effect, combined with the sector's robust performance, truly delivered. So, what critical lessons can we extract from this hypothetical journey with QQQM? Firstly, it highlights the immense power of compounding and long-term investing. Even a modest initial sum, given enough time and exposed to a growing asset class, can achieve substantial returns. This isn't about getting rich quick, it's about consistent, disciplined investment. Secondly, it demonstrates the potential of diversified exposure to a specific high-growth sector. The Nasdaq 100 isn't just one company, it's a basket of top performers, spreading risk while capturing significant upside.
While past performance is never a guarantee of future results, this case study illustrates the historical tendency of innovation-driven companies to outperform over extended periods. Finally, the importance of patience cannot be overstated. Market fluctuations are inevitable. There were certainly downturns within those 5 years, but staying invested allowed the portfolio to recover and reach new highs. Finally, it reinforces the value of ETFs like QQQM for accessibility. They provide an easy, cost-effective way for everyday investors to participate in sophisticated market segments without needing deep individual stock analysis. Understanding these principles is crucial for anyone looking to build wealth through intelligent investment decisions. This exploration into QQQM's hypothetical 5-year performance should spark some valuable insights. Did this result surprise you? Are you invested in similar growth-oriented ETFs? Share your thoughts and experiences in the comments section below. Your perspectives add immense value to our community's collective learning. Don't just watch these hypotheticals. Consider how these investment principles apply to your own financial journey. Engage with the data, understand the trends, and always remember to conduct your own thorough research before making any investment decisions.